Well, I think as a portfolio manager, it's important not to panic, but it's easier not to panic if you haven't been euphoric in the preceding period. I think as sort of fundamental asset manager from a macro standpoint, to some extent, it's important to fade the highs and the lows because our clients are not hiring us for a roller coaster ride, but what they really want is stable returns and diversification, and they don't want the downside when we see these upsets. So I think it's an interesting period. Markets are always giving us interesting periods. It is easy to blame central banks, but central banks, for their part, have actually been trying their hardest to be predictable and give forward guidance about what's going to happen. They haven't let inflation run out of control. They have telegraphed in advance that there will be tapering and then normalisation of
so Goldilocks is still okay. Goldilocks is just has got a black eye and looking a bit duffed up, but actually we're still in that scenario.
The fundamental firstly, fundamental value of assets, equities, bonds, even exchange rates hasn't really changed in the last couple of weeks. Secondly, the macro thematic or geopolitical risks have also been rather subdued for quite a long time now. I think the background music on both valuation and more near-term macro influences hasn't really changed, that's true. But we have had a period that's been more than 12 months long with amazingly low volatility, steady market gains and very, very little interruption from that. And that is unusual as well.
That environment's been difficult for a lot of fund managers, right? So, I mean, we've spoken to long-term investors who've talked about dynamic investing strategies responding to some of the market conditions because of low volatility and low yields. And some of the ETF products that showed issues in the last 48 hours or so were products that moved very, very aggressively in a short time frame, but potentially some that fund managers were holding because of the market environment. Do you think a lesson was learned, and do you think we're now flushing out some of those volatility products that fund managers might have used that typically they wouldn't have used in the past?
Yes, I think so. I mean, long periods like we had over 2017 do spawn a generation of investment products that are designed to do very well in that kind of situation, and it doesn't last forever. So market operators that are rule-based or leveraged or inverse ETFs, that kind of thing, that are forced to react to what's happened and do so, obviously experience some damage.
The complete opposite of what you came in saying us about, steady companies who are going to be there regardless of the crisis, whatever. That's what you said, and that's where you are, and that's how I think fund managers should be. So full marks to you for the kind of product that you're answering Karen's question about. No fund manager should be in. Inverse volatility leveraged product. Now, I have, just about understand a lot of that because I traded a lot of this stuff previous as well. But most people don't understand this stuff. Most people don't understand the risk of a leveraged product because on the mark-to-market, and anyway, you lose all your money anyway. B, on the fact that they're inverse, just has a whole host of issues. C, they're synthetic products as well in many cases. Nobody should be in. They should be illegal, these products, shouldn't they?
Well, they are risky, non-linear and very volatile. I would say, speaking for myself, they're not part of our investment toolkit.